Alright. Good morning, guys. I hope your investments have been doing well over the past few days. This has been one of the volatile weeks that we see as a theme going towards the end of 2018 and probably will be carrying forward into 2019. Over the weekend, the G20 summit went well. China and US called a 90-day truce on the trade war. Investors took this as a positive sign and went to celebrate on Monday with a buying frenzy that shot the market up some 2 to 3%, depending on which US index that you're using. Although nothing concrete was discussed during the meeting, they just said that, all right, we'll come back to the table, we'll talk some more, and we'll put off some tariffs and call a truce for 90 days. On Tuesday, the yield for 3-year Treasury notes surpassed 5-year Treasury notes. This means that lenders are now willing to accept higher interest rates for shorter-term bonds than to write out longer-term loans. What this means is that there is more uncertainty that lenders see towards the near-term future, like for the next 5 years. Probably a slowdown in growth. This also shows that lenders rather have their money back sooner than later, and thus the higher interest rate for the 3-year Treasury note. Normally, interest on loans increase with duration, as loaning money for longer periods of time is considered more risky. If I loan you $1,000 for 1 year, that's less risky than if I loan you $1,000 for 3 years, because where are you going to be in 3 years? So some market analysts take this inversion of the yield as a sign of a recession, which tends to follow after the yield curve inverts like this. But looking into 2019, we need more data before we can conclude that whether or not a recession is nearby. Sticking throughout a similar theme in my videos on my blog is just to be wise about your asset allocation and brave for rocky ways ahead. Retail investors should not try to mimic complicated strategies that institutional investors or quick-talking trade professionals use. Like, they try to time the market, they try to use technical graphs, they try to short the market, they use leverage. These are not things that retail investors should do, because I don't think that as a retail investor, your goal is not to make the most money. Your goal is to make sure that you save enough money and compound interest works in your favor so that your retirement goals, your purchasing goals are met at the end of the day. So the strength of retail investors, especially young ones, is the cash flow that they will continually put to work into either their retirement account or stock brokerage account. And diversification is key. Most investors would be better off thinking investing as savings. Trust me, guys. It will help you sleep better at night if you do so. So as usual, if there's any questions or any topics that you want me to talk about further, let me know and I'll see what I can put up. Thanks for watching.